just sort of half understand what's going on. And the full understanding, which I think they're stumbling towards, is that it's not gold going up, it's the dollar going down. So the squeeze, I think, is going to be on the shorts as things develop, as, say, the Feds pivot. This is going to be extremely difficult for the bullion banking community. So they've got to look at their mining operation and its costs and returns in that context. Now, the dollar going down basically means that costs which are quite sticky.
In today's episode, Alasdair Macleod's insights shed light on a potentially bright future for gold. What he suggests is that the stars seem to be aligning in favor of this precious metal. At first glance, it might appear that gold is on the ascent, but Macleod encourages us to look beyond the surface. He posits that the real story lies in the declining value of the dollar. As the dollar weakens, gold often takes center stage as a safe haven for investors seeking to preserve their wealth. However, there's more to the story. Macleod sounds a note of caution by pointing out the substantial short positions in gold held by certain banks. In essence, these banks have made bets that gold prices will fall. If these bets turn out to be incorrect, it could potentially put these financial institutions in a precarious position. This serves as a stark reminder of the volatility that often lurks within financial markets and the inherent risks that come with such uncertainty. In conclusion, Alasdair Macleod's insights into the changing priorities of institutions like the Federal Reserve, the weakening dollar, and the significant short positions in gold paint a picture of potential opportunity for investors. Beyond the financial jargon, Macleod reminds us of a fundamental truth. Gold is not merely a commodity. It is a form of money with intrinsic and lasting worth. This understanding equips individuals, regardless of their age or level of financial expertise, to navigate the ever-evolving financial landscape with wisdom and foresight, ensuring their financial security in a world of uncertainty. So, whether you're a seasoned investor or a curious teenager, the story of gold and its role in shaping our financial future is one worth exploring. Hit the like button, smash the subscribe button, and turn on the notifications bell so you do not miss out on our daily videos featuring the top financial experts on YouTube. And check our pinned comment for some huge sign-up bonuses, especially if you plan to add crypto to your commodities portfolio. Let's get into the video.
I mean, the effect is that there is a transfer of value, yes, obviously. But you have to bear in mind that gold is legal money. I mean, the eponymous J.P. Morgan himself said, gold is money and the rest is credit. Mm-hmm. That was true in 1912 when he made that statement, as it is today. Legally, gold is money and the rest is credit. The problem comes when you detach credit in terms of its value from gold. We've been like that now for 52 years. And the only reason that this detachment has lasted this long is because of the propaganda and the bullying efforts of the American-led financial system to try and dissuade us that gold has anything to do with the financial system anymore. It's a pet rock, they say. Mm-hmm. No, if you delve into the law, you will see the reason, for example, that it's on the balance sheet of the Fed at $22.22 to the ounce is because that is the official price of gold. Mm-hmm. And, if gold was a pet rock, it wouldn't be there, or they would value it at market. But no. So, and this is also why, when it came to the Bretton Woods Agreement, Nixon could only suspend it. He could not completely deny it or follow it up with legislation saying gold is no longer money. Mm-hmm. No. And this is why I think it's desperately important for people to realize it's not gold going up. It's their dollars, their pounds, their euros, the yen, whatever it is, going down. And when they go down and there is nothing to stop it going down because of what their government's doing to their currency, then there's going to be no end of it. And I can't really see any practical way in which the US government in particular can return to the situation. I mean, from every which way. Look at the fact that they've been denying that gold is money in defiance of the legal position. You have the whole of the economic establishment not understanding the difference between money and currency. You have got the geopolitical situation because the Russians and the Chinese understand that gold is money. They've been accumulating gold for that reason, and they have substantial reserves which are not declared as official reserves on the balance sheet of their central banks. The geopolitics of a dollar price shooting up from the American point of view, I mean, are just too horrendous.
As we head into the holiday season, remember that trading in the market can slow down a lot. So don't worry too much if silver doesn't show big moves in the coming week. If it dips a bit, that could actually be a good time to buy. But let's talk technical stuff for a sec. If silver drops below something called the 50-day EMA, it might go down to the 200-day EMA, but that's not something we expect to happen right away. It would need a big economic problem to make silver less popular, especially since it's not just for investing, but also used in industries. So keep an eye on silver and also gold because they often do similar things. In general, it's probably better to think about buying silver than selling it, even though the market can be a bit crazy. Just be careful with how much you invest and remember that things might get a bit tricky with less trading going on during the holidays. Please subscribe to the channel. Make sure to share this video with someone who doesn't have enough commodities in your portfolio and watch the video to the end as we continue to show you the interview with Alasdair. Enjoy.
I mean, if you're managing such a thing, really what you're interested in is paying the bills, cash flow and all the rest of it. And you don't want the risk of not being able to do that. And that is why you go into the futures market and you sell your production forward so that you can guarantee the value of your gold or your silver or your nickel or your copper or whatever it is you've mined. So that's the reason that you go into it. Now, the fact that they're not doing it, I think, means that perhaps one up from the managers of the mines, the boards of directors are beginning to just sort of half understand what's going on. And the full understanding, which I think they're stumbling towards, is that it's not gold going up, it's the dollar going down. Mm-hmm. So they've got to look at their mining operation and its costs and returns in that context. Now, the dollar going down basically means that costs which are quite sticky, things like wages, things like machinery and so on and so forth, those aren't going to rise immediately along with it. So that's good. On the other hand, you've got things like energy, oil, the energy input, if you like, which is such an important part of mining. That is a wild card. So what you could do is you could cover your position on, in oil futures by buying it forward. So you can see that this is a sort of multifaceted thing. Once you begin to get the idea that actually what's happening is it's not so much gold going up, but it's the dollar going down. Now, I think it would be too much to say that the directors of mining corporations already look at it this way, but I think this is the direction in which they're stumbling. And on that basis, when they get a call from their favorite bullion banker saying, would you like to cover your position forward? They say, well, yeah, we see the Chinese are buying, we see this buying. I think we'll just hold off for the moment. And I think this has been interesting because what it's meant is that the producers category on the commitment of traders report, they've been gradually reducing their forward cover, selling forward. And what this has done is it's left the swap category, which are basically the bullion bank trading desks in the majority, and a few other market makers types, if you like. left holding a short position in the market. And so this is really rather uncomfortable. We haven't seen open interest on COMEX really soar yet. I mean, it sort of got just over 500 contracts on the gold contract, but it has been quite a bit higher. I would say over 500 is probably getting a little rich, but could go quite a bit further. And that's the sort of feeling. So there's by no means does the market feel overbought in that futures market. Of course, that's only 1/8, roughly, of the derivative markets, the balance being in London. London's far, far larger. But this, I think, I regard COMEX as being the canary, if you like, in the gold mine, to paraphrase it. And so on that basis, I think, this is interesting. I think we're probably seeing the bullion banks getting in increasingly sticky position. I mean, the gross shorts are in the order of, I don't know, 50 billion or something. I can't remember what the exact figure was. But I mean, this is huge. Spread between, 29 parties? I mean, this is big. I mean, we're not quite 2 billion average each. And some of those will be considerably less and others considerably more to make up that average. Mm-hmm. So this is not a